Welcome back, and we're happy to report that we had yet another solid quarter of returns in the capital markets. Be it global equities or fixed income, year to date, most investors have enjoyed positive returns. While this is a favorable development, what we find intriguing is that there's a story within a story. Namely, first of all, how did we get here? If one were to go back to May of 2015, you would know there were a lot of divergence between bond yields and stock prices over the course of time. Ironically, they ended up right where they started 18 months later, right as we headed into the US presidential election. From there, we saw both bond yields and stock prices rise on the hoped for expectation of fiscal stimulus reforms to spur economic growth. That lasted with us until about mid-March, until the point where policy uncertainty started to set in. You saw bond yields decline, but stock prices marched higher. So in the absence of policy decisions, what's driving stock prices higher? First of all, volatility remains low. That emboldens investor confidence. Secondly, inflation has remained in check. That lends the valuation support for stock prices. And lastly, the global economy remains firmly in expansion territory. Another element that we find intriguing is the fact that the yield on S&P 500 stocks remains that above what you get on 10-year Treasury yields. In historical periods where we had conditions like that, that's been a favorable backdrop for stock investors. But the complexion of returns is going to take on a different form in our view. That is relying less on multiple expansion, more so on identifying those companies that have persistent earnings growth, as earnings is going to be a bigger component of the equation as we go ahead. The good news on earnings is they're increasing. After 3 years of wandering in the desert, we're seeing them elevate higher. But the other element that we need to be mindful of is not all stocks are created equal. In particular, the stocks that have the highest dividend yields are still trading at a premium to their long-term average, while those companies that have a persistent level of earnings growth are trading at a discount. This, in our view, is fertile ground for stock investors. But the need to be active, in our view, is going to be critical. That is, hiring someone at the wheel who knows how to identify the winners and avoid the losers to mitigate downside risk. Equally important on the active management side, we think, is fixed income. That is, maintaining a balance between rates and credit, or high quality bonds and high income bonds, given that yield spreads have narrowed to the degree that they have. But you need to be selective. In particular, if you go outside of the high yield credit box, we're finding that BBB rated bonds, while offering a comparable yield, also give you a higher degree of credit protection. Also, as a diversifier, we recommend considering emerging market local bonds. Not only do they provide that needed diversification in an uncertain world, but they're giving you a yield advantage beyond what you could get in a US high yield market. But for those investors who are worried about the impact of their bond portfolios due to initial rise in interest rates, fear not, because our research has shown that over a 17-year period, there's been no rolling 2-year time frame where either US bonds or dollar hedge bonds have generated a negative return, but you need to stay invested. So, what's the success for the path ahead? It's 3 things. Go global, stay balanced, and be active and selective. Thanks for joining us, and we'll look forward to seeing you next quarter.